Good morning. Thank you for watching here on Taxes Made Easy on the smartmoneyculture.tv. Have an interesting show because, again, I've been trying to talk about some of the tax proposals coming out from the Biden administration as well as the Trump campaign. And again, from what was being said, there wasn't much difference. That changed yesterday. So I think it's interesting and helpful to take kind of a deep dive into what the changes are as we come through. So Biden texted out or tweeted out yesterday that he would let the Trump tax cuts expire. And what does that mean for average citizens? Are your taxes going to go up? Will you end up paying more? It depends. So stay tuned, and we'll be doing a deep dive into that. Welcome back, everybody. We've got an interesting show today. Very excited about some of the things we're going to be covering because it's all about taxes and how they're going to affect your wallet. So again, trying to make understanding taxes and tax policy make sense to the average American. That's the whole goal here. So we're going to start off on a couple of articles. First one of concern is people can't expire. So can't retire. I spoke with a couple yesterday, and I've seen this. People that are educated, people that have, had good careers overall, and don't have money to retire on. So that's a scary thing that you get close to retirement, and then when you do retire, Social Security gives you $1,000 or $2,000 at most, and that's not enough to live on. And then they're thinking that they have to continue working. So here's this Newsmax article talking about AARP. They do regular surveys saying that 25% of adults 50 and over never expect to retire. They just don't have enough savings. They haven't prepared for it. So again, 1/4 of U.S. adults and 70% are concerned about rising inflation. So prices rising faster than their income. Again, the actual inflation is not being covered by what the government is claiming is inflation. Sorry, my nose. So again, this creates a real money crunch for retirees if you don't have enough saved and you're not staying on top of inflation, which is tough to do today. With the stock market taking another big hit lately, it's going to be tough to provide for yourself in retirement. So biggest are housing costs, rent and mortgage, and then everyday expenses like food, gas, etc. It's just harder than ever to survive. So it talks about how many of them have credit card balances. 37% are worried about meeting the food and housing. Those are the biggest concerns. So this is something that they financial advisors talk about all the time. Prepare, because Medicare and Social Security, if you don't have anything else, will leave you in the poorhouse. I spoke to a gentleman yesterday. He's getting $950 a month in Social Security. That's not enough to live on, not enough to survive, and so it's kind of sad to see this happening, and so that's one of my big things to use. And that's one of my goals of my show. And what we do as a companies, we help people fix tax issues, and we try to steer them in the right direction. So moving forward, they can retire with grace and security, knowing that they've prepared, that they have enough set away, their housing is paid for or largely paid for, and they can retire in comfort, as most people hope to do. The idea that people are going to work forever just becomes, there's so many issues with it. Health becomes a problem. You don't get to sit and relax and actually enjoy family. And so it's tough. So prepare now. Get your house in order now, so that way you can prepare for the future. Now, I'm going to share an article, and this is a little, you could say it's a little personal for me. I kind of chuckle at it. When I was a kid, back in middle school, I was a newspaper boy. And I was in Sacramento, California area, or the Valley, and the paper I delivered for was the Sacramento Bee. So it's not a nationally known paper being from Sacramento, but it's the main paper in the Northern California area, Sacramento region in the Valley up there. And I think this is hilarious. Is California really a high tax state? One of the reasons I think the Sacramento Bee is relegated to general obscurity is that it's not a serious paper. And I say it's not a serious paper. It's like every now and then from the LA Times, they come out with a serious article that actually challenges what's happening in California. And I've quoted the LA Times quite a few times, but you read its normal editorial page or whatever, it leans solidly left. Sacramento Bee has the pom-poms going. They're cheerleading full on for the left, and they are not very, this is an interesting article. So this is an example of the articles to be aware of out there. Now, do you have similar articles on the right? Absolutely. Absolutely. Where nothing Biden can do goes well. Everything's doom and gloom. Given the current state of the economy, there are a lot of articles out there like that, and sometimes I'm concerned that I can sound like it's all doom and gloom. But I'm hoping to be informative more than anything else. So this goes into, is California a high tax state? So they say, well, of course it is for the rich. But if you're poor enough, California is not a high tax state. It's the whole gist of this article. But of course, the headline claims, oh no, California is really not a high tax state. But when it goes into it, and what it does is it has the highest top income tax rate, and it has a gasoline tax that's routinely among the highest each year, and then people from Texas and Florida always pointing out how high the California tax burden is. And is it higher than Texas and Florida? Absolutely. So, but then they say if you're making less than $145,000, then your tax burden is actually close to the national average, which is around 9.5%. It's still over the national average. But the problem is it's not just about income tax, and that's what they focus on. They say here, the income tax burden is $145,900. So, I'm sorry, let me clarify. They're claiming that just looking at income taxes, that the tax burden is not that bad compared to the country. And when you narrow what you're looking at, it's like statistics. Anybody can look at statistics and cherry pick what they want and make a claim that can sound ridiculous or startling. And this is exactly what this article did. So they try to claim that for people paying the lowest income, they're within a percentage point of the national average. So they're 1% over the national average. But as you go up the next group, so this is really your middle class, your business owners, etc. They're paying 10.8% of their incomes in state taxes this year. This is on top of the federal rate. So when you combine it together, that's 10.8% just in income tax. And you're ignoring property taxes, you're ignoring gas taxes, you're ignoring all the fees that go with living in California. And then it kind of breaks down the numbers. U.S. average is 9.5%. Average California. If you're in the top 1%, that's where you really get killed. It goes up to 12% average of their income, and that's just in state taxes. When you add in federal taxes, it's close to 50%. So it kind of breaks it down. I'm not going to go that much deeper into this article. It's just when you see a claim that doesn't make sense or it goes counter to what people are expecting, we just ask some questions here. So this next article, and again, I consider myself pretty right-leaning, but this is something that I don't think is a horrible move by the Biden administration. So I'm sure there's plenty of people that will disagree with me. So this is from townhall.com, and townhall.com leans right, and they come out, but they do present both sides of of the issue in this article. So again, they announced yesterday another change, and this is interesting that we're getting almost a change every day coming out of the Biden administration. Very pro-worker, but at the same time, every single time you make an announcement like this, who is it hurting? Who is it affecting? Businesses. Who does it affect the most? Small businesses. So the non-disclosure agreement, banning those yesterday, really does hurt small businesses. Who's not affected by that so much? Large businesses. The Corporate Transparency Act. Who does it hurt? Who has to do most of the reporting? And who's going to get hit most with the penalties? Small businesses. So the problem here, I think, isn't so much one rule or trend. And if you look at them individually, these ideas can sound good. I mean, this one I have a hard time disagreeing with. But on the flip side, when you look at the totality of all these rules, it's just chipping away one rule, one regulation after another, making it harder on small businesses, easier for workers, but at the same time, what do you get when the saying is that when you tax something, you get less of it. That's just the general trend. So we're going to dive into this, explain to this, but we're coming up on a break real quick. And then we're going to be really tearing into our main topic of the day, which is Biden's new announcement, which kind of is a surprise. It's countered what had already previously been put out there in campaign stumps, and speeches. But we'll be right back after this short break. Welcome back, everybody. So, going back to this article, the Biden attack, Biden administration's new overtime rule blasted as an attack on small businesses. But let's kind of get into the meat of this article. Um, Currently, so it kind of goes down here to some of the numbers. So what they're doing is they're raising the threshold where people have to be paid hourly instead of salaried. Now, that sounds good. Businesses, taking advantage of people, having them work 50, 60 hours a week. Some, if people, if you have someone that's an assistant manager at a fast food store or restaurant, or a fast food restaurant can work crazy hours and not get a lot of pay. A lot of people starting off in different jobs, depending on the job, and especially if they're starting out in a profession, they can work a lot of hours. So currently it's $35,568. That is not a lot of pay in 2024. And the plan is to increase it to $43,888 by July, or beginning of July. Until this gets reversed, this is going into law, and then by January 1st it goes to 58,656. So that's my problem with this. It sounds good, like, hey, we're going to increase this so that people making less than 40,000, they're not working 60 hours a week and still making less than 4,000 a month. I mean, that's not a lot. That's a lot of time and effort for not a lot of pay. But again, when you put in a business employees, now that you're going to have to pay them a lot less hourly, but again, everything's going up, and then they'll have to pay overtime. This is a huge expense for small businesses. And who can handle this better? Larger corporations. Every time you do this, it hurts small businesses. 58,656. Now, if you're in New York, that sounds fine. But these are national. You go to the national standards. If you go to the Midwest, if you go to across the different countries, if you have someone working as an assistant manager at a fast food place, they're not going to be making 60 grand. That's a huge burden on a small business. So it doesn't just stop at the 43,000. It jumps another 15,000, almost 15,000 to 58,000 by January 1st. That's less than a year away. How do small businesses prepare for this increased cost? So I like the idea personally. I think, we might need to bump that up or peg it to inflation or something to increase this a little bit. But it's one of those things that whenever an idea sounds too good, it means it's hurting other people out there. And so this is currently, $35,568 a year, which is $684 a week. That's not very much. It doesn't sound like very much at all. But one of the biggest complaints about this is that you have, this is from Alfredo Ortiz, CEO of Job Creators Network. Again, it's attacking small businesses more than anything else who are going to not be able to handle this cost. And it hurts hardworking employees trying to climb the corporate ladder. So people trying to get the foot in the door, trying to prove that they deserve our position. So if you go in the corporate world, which thank goodness I've never been part of, this is how they judge people, see who really wants to move up in the world. I'm not so sure about that, but again, that by increasing it, the total increase really from 35,000 to 58,000, that's a $23,000 increase in a year. That is huge, and I think that instead of doing it incrementally, and then moving forward, it'll be updated every 3 years. So again, it'll continue to jump like this, and that could be a huge burden on small businesses. So I want to get to our main topic for the day, and and goes back to, I've been talking about this, how in previous speeches and information put out by the Biden administration, they said, no, we're gonna keep most of the Trump tax cuts in 2017 in place. And one of the reasons for it is because, again, it was attacked, it was vilified by the left, but it did lower rates across the board and generally helped the economy. So this is from the Federalist, but again, these articles are all over the place. You can, look it up. So again, this is the tweet that was sent out directly from the Joe Biden campaign. Donald Trump was very proud of his $2 trillion tax cut that overwhelmingly benefited the wealthy and biggest corporations and exploded the federal debt. That tax cut is going to expire in 2025. And if he's reelected, it's going to stay expired. So what does this mean? If he did a $2 trillion tax cut, that means by letting it expire, that's going to be a $2 trillion tax hike. And that's not over per year. That's over 10 years. So again, it's when you look at the federal budget, and this is really what we're going to be talking about the rest of the day, or the rest of the show. The federal government doesn't have an income problem. So this idea that we're going to tax the rich more, and it's all about punishing people. It's all about the federal government grabbing more dollars. Usually it doesn't result in more taxes. Because it reduces productivity. People say, forget it, I'm out of here. They move, they shift what they're doing to avoid these taxes. And again, there's more information that I'm going to be sharing about these latest proposals coming out. And again, yesterday, the understanding was that they were going to leave the Trump tax cuts alone. Well, most of them, except for the wealthiest. Now they're going to get rid of them across the board. So again, it talks about, and again, this is from a right-leaning perspective. So this is new news that they're going to let this go. But here's some articles: New York Times, Washington Post, both acknowledged that everybody benefited. The question is, they said it helped the rich the most. Again, raw terms, yes, it did, because they pay the highest percentage. And 23, the top 1% paid 8 times the rate paid by the bottom half of taxpayers. So it's hard to benefit the poorest the most when they're not paying any taxes, or very, very little in federal taxes. And this kind of goes into the idea that the rich aren't paying their fair share. They're paying half the federal taxes, the top 1%. So by far in America, the wealthiest pay the most. So again, overall, they're claiming that the tax cuts from Trump's tax cuts made the code more progressive. So what does it mean to make a tax cut more progressive? Progressive versus regressive. Regressive is where it actually hurts, and there's a bigger burden felt by the lower and middle class. Any increase to payroll affects the lower and middle classes more than anybody else, because people stop paying Social Security at a certain point. It becomes a zero-sum game. There's no way they're going to benefit more. Once you're paying, I think it's $10,000 something a year in Medicare, Social Security, it stops taking more money from you. And that's for the business and individually. But again, the argument here that the Trump tax cuts actually percentage-wise benefited the middle class the most. So, and again, it kind of gets into the details on that. I'm not going to really, my point isn't really to, and what my goal isn't really to argue this. It's just to understand what to expect if they let these go, if they let the Trump tax cuts expire. So again, reduces the, again, they use words like slash, but it would decrease the child tax credits from $2,000 to $1,000. It would make it so you can claim more dependents, but at the same time, the corporate tax rate was 35%. It got cut down to 21%. So what happens when you have these extra taxes on corporations? It reduces people's gains in their 401ks. It reduces overall productivities, and then it gets passed on to consumers. And higher prices. So more taxes, higher prices, more inflation, just adds fuel to the fire. Again, they go into how there's a lot of hysteria about the tax bills. I'm going to skip over that. So when it was passed, the real GDP increased 3.1% compared to 2.5% the previous year. Price index went up, only increased 2.1% compared to 1.9%. So the economy increased faster than inflation. That's what we need. That's real growth. And so moving on to the next article, I want to talk about the next article here, talking about the tax bracket. So this is from Fox Business. So what are the actual rates, and what will this mean for you as a taxpayer? And this is really what we want to focus on, is how is this going to impact you if it happens. So again, this is reduced top individual bracket from 37 down to 37% from 39%.
Increasing tool life,
and doubled the size of the standard deduction. This is the biggest help here. So doubling the size of the standard deduction. Currently, it's at just under $14,000, or it's right around $14,000 per individual. If you're married filing joint, it's $28,000. If you get rid of that, that means the standard deduction drops down to $14,000, which means across the board, a lot of poorer people are going to be paying a lot more in taxes. A lot of middle class, because the more income you get, the smaller the income or impact of a standard deduction. And most people that have higher incomes are itemizing anyway. So if you itemize, this doesn't really help you. But if you don't have if you don't have a mortgage, if you don't have a lot of contributions that you're making, if you don't have a lot of business expenses or student loan payments, you're not itemizing. And so if you're not itemizing, it's usually people with less money. People, I would say, under making not only less than $400,000, but less than $200,000. And it will hit the middle class and lower income the most. So people that weren't paying taxes under the Trump tax rate cuts will start paying if we let this $2 trillion tax cut expire, or the Trump tax cuts. So again, this is from Erica York at the Tax Foundation. Most Americans will see their personal tax bill rise and incentive for working and investing worsen. So let's look at some of the details here. This is prior to the TCJA. Tax Cuts and Jobs Act is what the actual name of it. So you had a lot more tables here. And this is 10% for people making over $9,525. Now, with the individual deduction being half of what it currently is, any income over $7,000 is going to be taxed at 10%. So pretty much everybody that makes, anybody making over $7,000 is going to be taxed at 10%. That's going to hit a lot of poorer people. Ironically, people complain about the people not paying anything, but then you do have increased deductions for for children. So when you get rid of cut the standard deduction in half for primary and secondary on a tax return for husband and wife or spouse and spouse, having a lot of children can help address that. But it gets rid of the incentive. Again, that was a huge problem with fraud before. So 15% for, so this is up to 9,525. So really that's, if you look at the standard deduction of around 7,000, 16,000 or less. If you have 16,000 or less, you'll be paying 10%. Here, up to 38,700. If you throw in the taxable deduction, so this is a little wonky how they put this. So if it's over 9,525 to 38,000 minus the standard deduction. So really, if someone's making 45,000 or less, they're going to get taxed at 15%. If it's 90, if you go up to 93,000, you're going to get taxed at 25%. And these are all for individuals. So most people, anybody making more than 45,000 is going to get taxed at 25% for a single. Under that, it's going to be 15 and 10%. Let's compare that to under the TCJA. So the standard deduction is doubled. So when it says taxable income, it's not looking at the standard deduction too. So you have to make at least $14,000 to pay any kind of taxes. At least for individual income tax brackets. So you have to make more than $14,000 individually. So if you make up to $25,000, you're only paying 10% on this $11,600. So if you make $25,000, you'll pay $1,000 in taxes, and then it stays fairly low, 12%, up to this number of $47,000. But that's with the $14,000 deduction. So the individual deduction being $14,000, you'd have to make more than $61,000 before you start paying 22%. So that's $5,000 a month. That's squarely in the middle class. If you're making $60,000 currently, you can't afford a home unless you bought one, before all the crazy increases before COVID. You're living on a very tight income there. And most people are struggling at that level. And that's what I see day in and day out, talking to individuals. And even if you're over that threshold, up to, this is $114,000, you're still going to get taxed at 22%. So, and so that's adding the $14,000 standard deduction. But we take away the 22% on $100,000, that's 80. That takes $22,000 away. So that means out of $114,000, you're getting taxed. You're only walking away with under $100,000. Now, if someone's making $100,000 as a single individual, they should be okay. It's not enough in today's market to go buy a home. The average home is costing $111,000 right now, and so after taxes, that doesn't give them enough disposable income to go and try to purchase a home, or they're right there at that threshold. So again, it kind of gives you an idea how much the people try to get into homes, the costs and the taxes. So that's under the TCJA, but at $100,000. If you compare it to these other numbers out here, you're getting taxed at 28%. Below $100,000, it's 25%, whereas under the Tax Jobs Act, it's 12%. So up until that threshold, this is your middle class, the 10, 12, really up to this point. If you're single, making over 60,000, 22%, and then over 100,000, it's 20, goes up to 24%. But this is the middle class under if we let those expire, 10%, 15%, 25%. And then when you're making over 93,000 or 100,000 with a $7,000 standard deduction, then that's when it jumps up to 28%. Where are most of your small business owners? Right here, 28 and 33%. That's where your vast majority of small business owners are. Over here, where are your small business owners? In this area. So if you go over 200,000, yes, it's going to be fairly high, 32% compared to 33%. Not a whole lot of difference there. But really, this is where most small business owners are, the 28 to 33%, or 24 to 32%. So when you talk about the richest, and then it goes from 30 to 35 and 36%, whereas here it goes to 35 and then 37%. Not a lot of difference here when it comes to the richest people and the richest income earners. The biggest difference is here where it hurts, well, really these categories where it hurts the middle class the most. And then again, you're looking at 25, 15, and 10%. But remember, the standard deductions are much lower, so again, that's another huge boost to lower income earners. And I just blew through our break talking about this. Let me see where we are. So I'm going to put this on hold real quick, and we'll come back after the break.
This is the Nintendo Silver, the most versatile and accurate hydraulic tool holder at an entry-level price point. We've listened to the input from thousands of our customers and decided to bring the highest precision tool holding technology to a broader application base. What does this mean for you? Direct clamp hydraulic tool holding technology that used to be out of reach or unjustifiable is now available in an economic option. Increasing tool life or adding holder clearance is available at an attractive price point. Unlock easy-to-use concentric clamping by putting Tendo Silver to work in your shop today.
Welcome back, everybody. So again, just kind of dive into the numbers here, and this is where I went over a little bit talking about this. But the highlight here is when you're looking at these different tax rates. So this is pre-Tax Cuts and Jobs Act. It says 10%, 15, 25%, but you got to remember that the standard deduction is half, only $7,000. So the lower class, 10 to 15%. And that's up to $45,000. So here you have 10 to 12% up to 47 plus 14,000. So that's $60,000. So it's much more generous to people on the lowest income brackets. Now, where are your middle class, your business owners? And so 38 to 93%. These are your professionals. These are people earning good money, but up to 100,000 right now. And most professionals are making more than that. But this is kind of your middle class right here, 25 to 28%. But starting at 45,000 and going up, most jobs are. This is really your not just upper middle class. This is your blue collar workers, your union workers really are in this rate. 25 to 28% going up to 195,000. This is your middle class right here. If you compare similar measures here, again, this starts at 60,000 and up to 191,000, 22 to 24%. So really, when you compare similar brackets, it's 28% to 24%. That's a 4% cut for people doing well for themselves. They have a good job. But again, this is the backbone of America. This is the blue collar. So it's 4% difference here. If you go above that rate, over 200,000, really you're looking at 33% compared to 32%. Not much difference. If you go a little bit higher, 35 and 39, almost 40%, 35 and 37. Very little difference. And what you have to not forget is that this does not include, this is just income tax. This isn't looking at Social Security taxes, which adds another 7.5% tax onto this. So when people are talking about 24 or 28%, you add in Social Security taxes, that's another 7%, 7.49% to this, so that's 35%. If you throw state taxes on top of that, then another 10% at least, you're looking at 45% of someone's wages in this tax brackets, blue collar workers, professionals, etc. 45% of their taxes going to the federal government or state government. That's where the tax burden really comes into play, and this doesn't share the whole amount. So if you have a 4% cut in that, so instead of paying a total of 45%, it drops down to 40%. That is some relief. And so I kind of want to talk about the biggest things. It's 1 to 4% more in taxes across the board. And because you have higher thresholds and double the standard deduction, especially for single individuals, it's going to make a big impact. So I want to share, this is from Forbes, talks about the current, they crunch those numbers for single. Let's look at married. Currently, it's much higher. Essentially, everything's doubled due to the standard deduction. So if you're married with the standard deduction of $14,000, if you're making $35,000 or less, you're only paying 10%. Again, that's very low. But then this is where it jumps up to $89,000, almost $90,000. You add in the standard deduction, that is $113,000. No, $103,000. This is where most of the middle class is. 12%. If you're making less than $103,000, you're still struggling with home ownership. You're still struggling with other issues. Trying to get by in the economy. But thank goodness you're only paying 12% in taxes. You go over $103,000. 22%. So a huge 10% increase. But these are people making over $103,000 to close to $200,000, or just over $200,000. These are your business owners. These are your business, your company. So if you go back to the comparable tax rate, it's 28% versus 22%. And then you go over that number, it goes up to 24%. And again, I'm just kind of eyeballing this from one article to another. Then over that amount, then it goes up to 33% over 200,000. Whereas here, looking at this, if you go over 200,000, again, it's 32 compared to 33%. Not a huge difference. Well, that's over 400,000 for couples. But really, you're looking at 24% compared to 28% for the middle class. This is where your middle class is. This is where your job creators, your small business owners are. And again, it's going to hurt the economy, increasing taxes across the board. It's going to hurt everybody across the board to increase taxes. So that's just a given. By letting the Trump tax cuts expire, this is what they're suggesting. This is what they're proposing. I don't think it's going to help the economy either, which is, again, another frustrating thing. So understanding the Trump tax cuts, I think, is important. We've seen them in action for quite a few years and how they actually affect people. Right now, in a high inflation, government overspending is really the biggest part of the problem. When it comes to inflation, that's not going to stop. unless you get serious in Congress. And the Republicans and Democrats are not serious about it. There are a few lone wolves out there screaming in the wind, but even they're getting ignored by even Trump. So one of the things I wanted to follow up with, and again, this goes with this trend of increased taxes across the board. This is another Newsmax article, not only reversing this, but again, this is a little bit of an alarmist headline. It says 44.6% capital gains tax rate is a 100-year high. So essentially since when they started with capital gains, because they started with capital gains about 100 years ago. And this is a lot of this is coming out from his 2025 budget proposal. If you want to read the whole thing, you can just click on this link. And then you have all the articles, everybody breaking it down. So they say, 44.6%. I said, okay, well, what is it now? What is it currently? So when you look at capital gains, these are people, gaining, and this is the highest marginal rate. So this is currently, it's at 0%, 15%, and 20% depending on your income. So, and again, this goes into overall income, but it's taxed at a different rate. So up to 40, if you're single, up to 45,000, it's at 0%, long-term capital gains rate. 15% if you make from 44,000 to 400,000, which is where most people are, and then over 500,000, it's at 20%. That's where it stands currently. So this article doesn't really break this down. So they're taking the 20%, jumping it to 44.6%. And again, this, when you add on state taxes, other issues, 59% rate for capital gains. When you're taxing someone at 59%, what's the point? This is when people flee. This is when people are like, I'm done. This is going back to like Jimmy Carter era tax rates. People are, at this point, if you start hitting people, and capital gains are all about investments in the economy. Stocks, bonds, long-term things where people aren't doing short-term trades just trying to make a quick buck. These are people putting money into companies to invest, to hire people to work, to build factories, to produce. This is what we want to encourage. But now if they're going to be facing a 44 with state taxes, 59% rate. Would you do that? I mean, would the average middle class person go and invest that and face a 59% rate? The rich are more tax savvy. Of course, they're going to avoid. They're going to, it's not indexed to inflation. It really hammers people hard. China has a maximum rate of 20%, which is why ours was lowered to 20%, so we can be competitive with other countries across the globe. In 1922 is when this started, had a rate of 12.5%. So just to give you an idea of where it's gone up, it's gone down, but again, since the Trump cuts, it was down to 20% to match what China and other countries were doing. But here's another big thing, and this is kind of buried in here. This is a big issue, and I want to finish on this note. So again, these are all, again, 2 days ago, I thought that, and this is the information that was being put out by the Biden campaign, that they weren't going to increase the Trump tax cuts. They weren't going to increase taxes on anybody making less than $400,000. So they were proposing things to attack the richest. That's all off the table. This is a huge reversal. And this is a huge issue right here. You talk to financial advisors, you talk to CPAs, this is going to, anybody getting an inheritance that has property, they're going to get rid of, eliminate a stepped up basis upon the transfer of assets upon death. So this triggers a mandatory capital gains tax event and they're proposing to increase that all the way up to 45%. Coupled with state taxes, you can be paying 60%. So what happens here? And this is the typical thing. Explains. I could do a whole show on stepped-up basis, and I probably should. So if you have a family farm that's been in the family for generations, and the father, etc., passes away, when it's put into a trust, or when an estate passes that on, if they do that correctly, let's say the farm was worth $500,000. That's probably really, let's say it's worth $1 million, but it's a family business that's been in the family for years. When they pass that from generation to generation, currently you get a step up in basis. So if the farmer is to, let's say he paid $100,000 for the farm, he's lived there 30 years, now it's worth, $1 million. If he's to sell that farm, he would get taxed on $1 million as it's commercial property. If he turns around and then it goes to his children, his heirs, when he passes, they get a step up in basis. So that means they treat it as if the heirs had paid $1 million. So if they turn around and sell it, that $1 million is tax-free. But if they keep it, they don't have to pay a huge amount. Getting rid of the step up in basis means that if they inherit $1 million farm, now they have to pay this 44.6% capital gains tax federally, plus any state taxes on it. And so if you inherit something, if you're paying 60% on any capital gains from property or other assets, you're going to have to sell the assets. If it's a family home, that's a huge tax burden on anybody inheriting property. And this is what they're really doing here is attacking assets being passed generation to generation. So if you go and you invest and you plan and you do everything right, this is a huge tax on anybody receiving an inheritance. So again, the estate is required to pay these taxes as if they sold the asset. So if you don't sell the asset, you still have to pay the taxes with this, getting rid of this step up in basis, and that before they can receive the property, they have to pay this huge tax bill on it. So overall, it calls for about $5 trillion in tax increases in the next decade. So it's not only just getting rid of the Trump tax cuts, it's hitting people in their pockets across the board. Yes, the wealthiest, but everybody else too. And people are just now digesting it because it just came out. So I'm sure we're going to be talking about this. I think I'm going to see if I can't have an estate planner come on and talk about this step up in basis and how this is going to really affect people across the board. Again, we're out of time. There's been so much information that just came out yesterday, and we're going to continue talking about it. If you have any questions, again, give us a call, 520-485-7371. Be informed as to how what's coming down the pipe can really hurt you and how to plan for it. So again, we want people to save. We want people to pass money on to create not only wealth for yourself through retirement, but to help. A lot of people want to help the future generations. If these are the laws going into effect, it should change a lot of that. So we'll talk tomorrow and have a great day.